Tuesday and Super Tuesday, rather. The election has become the game to watch now. In this morning's U.S. Bank Economic 360, U.S. Bank investment analyst Jim Russell joins us with a look at the stock market and the election. Jim, from a historical perspective, as we look back in history, how has the market fared under Democratic and Republican administrations?
Brian, good morning. I think that's a question on everybody's mind right now, and certainly the game to watch for the year ahead, as you'd mentioned. We have a graphic here that really gets to the facts. Now, there's a little bit of a perception that under a Republican administration, which may be a little bit more low tax, maybe a little bit more pro-business in its orientation, that a Republican administration would be better for the markets. The facts don't really bear that out. In fact, you can see here on the graphic that under a Democratic administration, on average, under a Democratic president, 85% type of appreciation over that administration for the markets, and certainly in the mid-20% range for the Republicans. So we have quite a bit of disparity. Now, one thing I would also bring to the viewers' attention is that even if you extract FDR's administration, which had colossal stock market gains, still the Democrats come out ahead in this particular metric.
As an investment analyst, why do you think the markets do so well under the Democratic administrations over the years?
You know, we've taken a hard look at that, Brian, and really once you strip out a lot of the data here and take a hard look, it's really the interaction of the president with Congress over that administration that really matters. Sometimes that, of course, road is a little bit bumpy, sometimes a little bit more smooth. That's the key dynamic, as opposed to really Democratic or Republican type of administration.
Let's turn to the idea of the incumbent. We have an incumbent Democrat running for re-election.
Right.
How does the market usually react to an incumbent winning an election?
It's an interesting question. We have a second graphic here that I think really points to, again, some of the facts. You can see some of the administrations really over the last several cycles and how the market reacts 1 year after the incumbent is re-elected. And you can see on average we get a 0.4% type of return, fairly modest, I think you would agree. So I think what that tells us is that, number one, the markets have anticipated the popularity of the incumbent being re-elected, and secondly, usually in the first year of a presidential cycle, very difficult and frankly unpopular decisions are often made, and again, the markets may not like that as much. So I think the combination of those two results in a modest market return.
All right, thanks, Jim. We'll follow this over the election here.
Yes, sir.